Hi, this is S. Kumar Pannala. So the purpose of this video presentation is to highlight the importance of cost accountancy, and we are going to discuss few concepts which are part and parcel of cost accounting. So this is most important. So before going further, we must understand why a particular subject was introduced when a strong financial system and financial accounting is in the place. So I'm going to highlight why the cost accounting has been introduced when we have a financial accounting system in place. So we start with the differentiation, then we move forward to understand the basics of cost accounting. So this is the agenda. First, we are going to discuss need of cost accountancy, then what is cost, what is costing, and finally we are ending with cost accounting. So after that, we are going to differentiate the interlink between these three concepts. So let us begin with need of cost accountancy. You know, financial accounting starts with journalizing the accounting entries. Then what we do? We post the entries in the ledgers. Then we make few adjustments. Then we are going to prepare a trial balance. So from where financial statements are prepared. P&L account, balance sheet, statement of equity, funds flow, cash flow, etc. So what is the agenda? The agenda is to highlight the financial performance and financial position of the company towards its stakeholders. That is the major purpose. So the main intention of financial accounting is to highlight the performance of the company towards external parties. That is the major agenda. Then the financial accounting has strong fundamentals, but having few limitations, which are very much important for effective management of company activities. So, in order to avoid some of these limitations and to optimize the internal performance and internal efficiency of the company, a subject called a cost accountancy has been introduced. In fact, it is a branch of financial accountancy. So we don't keep separate books of accounts for recording of transactions. But what we do, we use the same accounting information for costing as well as financial accounting needs. Then, so which limitation or limitations we are going to highlight in the financial accounting and how the cost accountancy is going to address these issues. So this is the basic agenda of discussion here. Point number one, costs are recorded on the basis of relation. So you can see in trading and P&L account, sales are credited and all expenses are debited. But expenses are debited according to relation they have with the product or service. All direct expenses are debited to P&L account. All indirect expenses are debited to P&L account, right? But we don't differentiate how much expenditure that was incurred in the production department, that was incurred towards administration, that was incurred towards selling the products or towards research and development. Means we are not classifying the cost on the basis of function. Instead, you are classifying the costs on relations. Then what happened? When you start recording the costs on a relation basis, it is very difficult to identify where the major resources are consumed for producing the product or service. In that case, it is very difficult to reduce the cost of the product, and it is very difficult to highlight the internal deficiencies of a company. So if you want to increase your profitability, first you have to highlight internal deficiencies where the major resources are consumed. So the financial accounting system fails to address the areas where the resources are consumed. I mean unnecessarily consumed. This is the first limitation. So then how we can address this? Don't write costs direct and indirect, and you have to allocate the cost according to production function, admin function, selling and distribution function, research and development function. When we scatter the costs on the basis of these functions, we can simply identify where the revenue is consumed towards provision of a service, so that we can exercise a few cost control measures to improve the internal efficiency. So this is the reason why the cost accountancy has been introduced. Here costs are not allocated on the basis of relation. We are allocated the cost on the basis of function. Second limitation of financial accounting system: not possible to ascertain profit or loss on product or service. You know, revenue is credited, expenses are debited to P&L. See, a company may have several divisions or several territories, and they are operating in the different areas like Andhra Pradesh, Tamil Nadu, Bangalore, like that, Kerala. So few locations are there. The consolidated revenue is recorded and consolidated expenditure is recorded here. So what you are showing in the P&L account, the consolidated profit of the company, but you are failed to highlight the segment wise or divisional wise profitability of the company, which is more important from management point of view. Suppose a company wants to know where it is suffering losses, where is getting more profit, then it has to identify revenues on the basis of segment, costs on the basis of segment, so that profit or losses on the basis of segment. Suppose if I want to discontinue the sales in a particular territory, how can I judge? How can I decide? I can decide only by comparing the revenues and costs and profits. So those loss-making territories or loss-making divisions cannot be identified in the financial accounting system. So in costing, what we can do, we can prepare the performance analysis sheets or performance reports on territory basis, so that the management can have a close look at the profit or loss that was it is getting from the operations of a business. So at one point of time, the management has to take a call. The business has been continuously operating in losses, they may take a call to discontinue the business in those territories. So this is not possible in financial accounting that we can achieve by implementing the cost accounting system. Third one, not useful for managerial decision making. In financial accounting, we can get the consolidated information, but in few situations, the management has to take decisions according to the corresponding changes in the external environment. Suppose you are a car manufacturing company. You are purchasing the tires from MRF. You have a capacity and you have a plan to manufacture the tires. Now you have two choices: to purchase or to buy the tires from the MRF, or you can produce the tire on your own facilities. This is called make or buy. Suppose the cost of making the tire, say 4,000 rupees, the cost of purchase is 4,500, which is cheaper, 4,000. Then what you have to do? Stop purchasing the component from outside vendors or outsiders, start producing on your own. That could save 500 rupees per unit, that will boost your profitability. So for taking a decision whether to make a product or buy from the external parties, we need the classification of cost according to its variability. How much variable cost we are incurring, how much fixed cost we are incurring. So variable cost is only the relevant cost. As you know, it always varies with production. Fixed cost, we don't care because it is a capacity related cost, and moreover, it is not relevant for decision making because it is constant up to one point of level. Hence, variable cost classification and fixed cost classification is relevant here, which is not possible in financial accounting. Second one, you want to introduce a new product in the market. How much selling price you want to decide? How much selling price you want to fix for the product? So that can be achieved by ascertaining the cost of a product, and we have to add the required margin so that we can arrive the selling price of the product. So selling price fixation is not possible as per the financial accounting, and we can't make or buy decisions. Point number one. Point number three, shut down or continue. A division has been continuously operating in losses from the past 5 years. Now we have to take a call. Can I shut down the business or continue as ever? So in this case, we have to take a decision. In this case, the management, what it takes the corresponding cost related to particular division, which is avoidable, which is unavoidable. Suppose all unavoidable costs are not taken into consideration. Based on the avoidable cost, unavoidable cost, we have to take a decision whether we should continue the division or shut down the division. So this is one of the management decision. So this decision can be taken with the help of the information provided by cost accountancy. Next, export market. You want to export the products to overseas. You know, costs are two types: variable cost and fixed cost. Variable costs vary with production, fixed cost don't, right? The cost of making the product is relevant. Now, let us assume we are a pen manufacturers having a capacity to produce 1 crore pens in a year. Right now, we are producing 70 lakh pens, and we had a ideal capacity of 30 lakhs. Now you got an export order for supply of 20 lakh pens, which is within the installed capacity. You have a capacity to produce 1 lakh units or 1 crore units. Still there is a surplus, 10 lakh units. Then, now you have to decide, export, don't export. So, you know, at 70 lakh units, you already recovered your full fixed cost. Now you are running in the profits, means you are already recovering the fixed cost. You are running in the profits. Now, for 30 lakh units, there is no additional fixed cost because we don't need to take additional buildings, we don't need to pay additional salaries, etc. Then, such a case, what is relevant? Fixed cost is not relevant here, only variable cost is relevant. In that case, the cost of making the pen is 6 rupee, fixed cost is 2 rupee, 8 rupee. We are maintaining a margin of 50%. 8 into 50 means 4. 8 plus 4 is a 12 rupee, is the domestic selling price. Exporter wants to purchase the pen for rupees 10. Then you don't compare this 12 rupees with 10 rupees. Domestic price is different from the export price. What you have to think? You have to deduct the fixed cost from the fixed cost while deciding your export price. Say 6 rupee is the cost of making the pen. 10 rupees is export price. Still you are getting a profit of how much? 4 rupees. So For deciding whether we should go for the exporter route or not, we need analysis of cost, variable and fixed terms. That is possible in cost accountancy, which is not possible in financial accounting system. So no scope for efficiency measurement. We don't have any standards for expenditure in financial accounting system. Material cost is debited, labor cost is debited, and manufacturing expenses are debited. Salaries are debited, insurance cost is debited, everything is debited once they are incurred. But means historical costs are debited here. Suppose material cost is recorded as 60 lakhs. Whether the 60 lakhs cost is justified for the production that you are achieving, if I ask you, you don't have any answer. Sir, the cost was already incurred, we are recording. Then, how can we came to know whether this 60 lakhs is relevant or not? That is by making comparison. So, in cost accountancy, there are few standards for all resources. Accordingly, we need to consume the resources in terms of that standards that was fixed by the management. Suppose 1 unit of output requires 2 units of raw material. You want to produce 1 lakh units. 1 lakh into 2 lakh units of raw material should be consumed for production. So the standard price was rupees 2. 2 lakhs into 2, 4 lakhs is the standard cost for this production. But for producing this 1 lakh units, you have consumed materials worth say 5 lakhs. What is the actual cost? 5 lakhs. What is the standard cost? 4 lakhs. This 1 lakh difference will kill your profitability. So we need efficiency standards for improving the operating efficiency so that improving the operating profitability. This is not possible while maintaining the financial accounting system. So all these major issues can be addressed by introducing the cost accountancy. So here production wise, all costs are recorded on product functional basis. Here we have a facility to make profitability statements on the basis of divisions and territories. We have a facility to take managerial decisions in order to address the few business issues, and there is a scope to improve the operating efficiency so that there is a scope to improve the profitability. So the major difference between financial accounting and cost accounting is that cost accounting is internal to the management, financial accounting is external to the management. The purpose is to report here. Financial accounting is to reporting purpose. Cost accounting is internal purpose, where we aims to reduce the cost of the product by improving the profitability. Cost control and cost reduction are the major drivers for introducing the cost accountancy. Then, so let us move forward for the remaining few items here. So first you have to understand few basics. What is cost? What is costing? What is cost accounting? So cost means the amount of resources used for the purpose of making the product or to render a service. It's a statement. The amount of resources we are using for producing the product or to render a service. Sir, I don't understand. See this. Shed is a product, right? So we are taking an example of a shed manufacturing company. You can see what is there. Cloth is there, buttons are there, thread was used in the stitching of the shed. So all these are resources. The cost of purchasing the cloth, the cost of purchasing the buttons, the cost of purchasing the thread, that we call it as cost. Cost means expenditure towards making the product. At the same time, we need an establishment to produce the product. So we should pay rent at regular intervals. We should pay salaries to all the supervisors. We should pay insurance. All these are other expenses. Other expenses, material, cloth, buttons, thread. All these cost components are called as material. The payment paid for the tailor for stitching the shirt, that is called labor. Salaries, rents, insurance, etc. are called as other expenses, technically known as overheads. Indirect costs are known as overheads. So material cost is there, labor cost is there, overhead cost is there. Therefore, the cost of all the resources, material, labor, overheads for producing the product is known as what? Cost. What is this gold ornament? I am the manufacturer of a gold ornament. It's a product. You can see gold here, you can see stones here. If I want to produce a particular item, then I need these resources. I should purchase the gold from gold suppliers, biscuit suppliers, and I need the stones which are required to be used in the manufacturing process. So expenditure incurred to purchase the gold stones, the amount paid to maker, and rent of the showroom, salaries of staff, electricity, all are collectively known as resources. The cost of all the resources which are used for making this product, this is called cost. I hope you understand the basic definition. Look at this. So this is a transport company, cargo transport company. What it do? It transporting the goods from one location to another location. See, the expenditure or amount of resources which are consumed for providing a service is called as cost. See, fuel cost, the salary paid to driver, salary paid to cleaner, toll gate charges, the cost of replacement of tires, etc. are known as cost of service. So this is cost. So first you have to understand what is cost. Cost means the amount of resources consumed for providing a service or to produce a product. Next one, costing. Next step, cost, costing. Now you understand what is cost. Now costing. Costing means it is the technique and process of ascertainment of a cost of a product or a service. It is simple. See, financial accounts, we start identifying the transactions. Then what you do, you start recording the transactions in the journal. Then those entries are posted in the ledgers, right? Similarly, first we have to identify the cost of a product. How much cost is incurred towards material, how much cost we are incurred towards labor, how much other expenses we are incurred towards production, etc. Once all the costs are identified, then we should make a statement to ascertain profit or loss from the product or service. Suppose I'm a mobile company manufacturer. I'm selling the mobile phones. Then what I do? I should know the cost of making the mobile phone. Then it should be compared with the selling price. Let us assume the cost of making the mobile phone is say 25,000. I'm selling it for 35,000. That means I make a profit of how much? 10,000 rupees. So costing is mainly intended to ascertain the cost of production. In our example, rupees 25,000. So how it is arrived? You should get the information of material cost, you should get the information of labor cost, you should get the information of overheads. Put together, total cost, the cost of making the product is 25,000. What is your selling price? 35,000. The difference is here 10,000. So costing is mainly intended for ascertaining the cost of a product or service and to know the overall profit or loss from the provision of service or production of an article. This is the main intention. Then what is cost accounting? Cost plus costing, we simply call it as cost accounting. So in cost accounting, we are ascertaining the cost of all the products and services. Again, these costs are recorded in a systematic manner. Just like in financial statements, financial accounts, what we do? Making journal entries, posting in ledger, trial balance, and finally P&L and balance, right? Similarly, in costing, we are preparing a statement called cost statement, where all the costs which are ascertained previously are arranged on function basis: production, administration, selling and distribution. The total year cost of sales. Sales minus cost of sales, the difference is the profit or loss from service or production of an article. So which is similar to trading and P&L account in financial accounts. Then cost accounting, cost accounting. In between, we use a concept called costing. Cost plus costing is equal to what? Cost accounting. So it is the process of accounting for costs, which begins with recording of costs and revenues and ends with controlling of costs. So we start identifying the costs. Then what we do? We are preparing a statement to know the profitability, and eventually what you're trying to do where the major resources are consumed. So how much material was consumed, how much money is paid towards labor, how much other expenses we spent. All costs are recorded on the basis of function, so that I can verify whether these costs are in line with the management policy or not. And I can see where the major resources are consumed, whether they're consumed in a right manner, if there is any excess consumption or not. So all these areas can be ascertained once we have the complete cost classification that is provided by cost accounting system. Then ends with controlling of costs. Suppose I have an observation that the material was excessively used beyond this is beyond the standard specified by the management. Then how can I know this? Because I have a standard. 1 unit of material, 1 unit of output requires 2 units of raw material, but you have consumed 2.5 units of raw material. So if you don't have controls in place, it is not possible to use the resources at optimal level. It is not possible to stop the excess cost, which will erode the profitability of the business. So it involves determination, classification, analyzing the cost and income of a business. How much cost we spent, then we are classifying material, labor, overheads, and again on the basis of variability, how much of the total cost is variable in nature, how much of the total cost is fixed in nature. This analysis is done, and finally, how much revenue you are getting from the business. So this cost and revenue classification is facilitated by the cost accounting system. So prices to be quoted to customer. Suppose you want to purchase a motorcycle. Suppose I am running a Yamaha company. You want a Yamaha bike, right? Then I should quote a price to you. How it is decided? First, I should know how much cost I am going to incur to make this product. Suppose the cost of making the bike, say 70,000. So I'm not operating a charity, I'm operating a business. So I need some profit. I need 50% margin here. 70,000 plus 50% means 35,000. My selling price would be what? 1,05,000. So I can fix the selling price only by knowing the cost of the product, which is facilitated by cost accounting system. So we can get the data from the departments, all the departments, and we will prepare a quotation here. Accordingly, we quote a price to the customers. So this helps in managerial decision making. I told you in the previous first slide, what is the need of introduction of cost accountancy. So all these issues are addressed here. So you can take make or buy decision, or you can take introduction of a new product or drop an existing product. I can introduce a new product in the market. I can drop the product in the existing market when it is outdated, it is not capable of getting enough revenue in order to cover all the costs. Third one, expansion of business through exports. Profitability analysis, territory wise, division wise, area wise, product wise, service wise, all we can do with the help of cost accounting. Planning and controlling through budgets. We have methods and techniques. Methods of costing are applied to know the cost of producing the product or service. Techniques of costing are mainly intended for cost control. So we have three techniques: marginal costing, standard costing, and budgetary control. Few budgets are prepared based on the past information, though the expenditure which is budgeted here is compared with the actual expenditure to know where there is any variations or not. If any deviation is there, the management will investigate. Material cost standard 50,000, actual 60,000. Extra 10,000. What is the reason for this extra 10,000? Is there is any rise in the price of the material, or is there is any rise in the consumption of material? So these two are the major factors for increasing the cost. Similarly, for labor, overheads, they prepare budgets and make comparison. What is the purpose? The purpose is for planning the resources, at the same time reduction of the cost. To establish standard of efficiency. So I told you standards are fixed for all the resources. For material, there is a standard. For labor, skilled, semi-skilled, unskilled, they are fixing a particular standard. Accordingly, they should produce the product. So if you don't have standards of resources, the resources are unnecessarily consumed. That erodes the profitability of the business. So cost accounting facilitates identification of cost, recording of cost, and preparation of profitability statement and reporting to management. And management has to take few managerial decisions considering the information provided by the cost accounting system. So all these issues are addressed with the help of cost accounting. So what is the conclusion? Financial accounting aims to report the profit, that's all. But it does not facilitate the cost control or cost reduction in order to improve the profitability. A strong cost accounting system increases the efficiency of operations through standards by optimizing the utilization of resources that helps to increase the profitability. So if you want to get more profit by reducing the cost or controlling the cost, we need a strong cost accounting system. So this is internal, financial accounting is external. So this is the basic of cost accounting. So this introduction is further move forward to know classification of costs and whatever elements that we are discussed, material, labor, overheads, those are the chapters we are going to discuss in detail. Then the techniques of costing, marginal costing, standard costing, budgetary control, all these three components, three topics are separately covered as chapters. And so I told you there is a separate system where we are going to operate the accounts in two sets of books. For costing one set, for financial accounting is one set. So the process of maintaining the books of accounts in the company books, we call it as integrated accounts and non-integrated accounts. This is about bookkeeping, just like a bookkeeping. So that is also covered in this subject. So material, labor, or its bookkeeping, where you are going to know integrated and non-integrated accounts. Then you are going to know techniques of costing. Then finally, so we are going to know various methods of costing: job costing, unit costing, operating costing, operation costing. All methods are discussed in detail. So this is about a brief, but you should understand these basics very clearly. Three basics are essential: cost, costing, cost accounting. Thank you.